Hi, I'm Pattu from freefincal. Today, let's talk about ICICI Prudential Value Discovery Fund and talk about whether it's on the comeback trail. Now, this fund has frustrated investors for almost 5 years and before the market crash, and since the crash, it seems to have recovered quite well. But the question is, has it recovered simply by investing more in the stocks that are heavy in the index? For example, you have Invesco Contra Fund. It's a Contra fund, but its largest holding is Reliance. It's got more than 10% of holding in Reliance, and it's a five-star rated fund. And you know that Reliance is very heavy in the both the Sensex and the Nifty. That's not much of contra investing, in my opinion. But I mean, the practical aspect of it is, look, when you show people a NFO document, right, an NFO presentation, then they'll get excited about the strategy. Oh, this fund has got something special. This fund is trying to do something special, and so on. But after they start investing in that, they won't care about the strategy. All they want is returns. They don't care if just to get higher star ratings or prevent a fall in star ratings. If the fund manager deviates from the investment strategy, they won't care because all they want is return. So, while evaluating a fund, at least as an analyst, you should check whether an improvement in performance is because of a deviation in mandate, or if they are more or less sticking to their guns. So that's why I'm talking about that. I had reviewed both ICICI Value Discovery and Quantum Long Term Equity in October 2019. I had said that if you believe in their strategies, stick to that. It will be a frustrating run, but you have to be patient. Now, Quantum Long Term Equity has done a little bit better after the crash, but it has not bet the Sensex or the Nifty or let's say NSE 500 over the last year. ICICI has done that, and that's why I'm talking about ICICI. Once Quantum Long Term Equity does it, I will talk about that. And this is the reason I have stayed put with Quantum Long Term Equity. I know that in the current market, it's very difficult for a value fund to perform, but that's expected. And as long as the volatility is reasonable, you have to stay put, and I have stayed put. I don't have any problems with it. I don't know whether it will turn around, and I don't even know whether this recent outperformance of value discovery is just a flash in the pan, or whether it's going to stick around for some time. We don't know that, but I'm just reporting a fact. Now, in October 2019, I had mentioned that both ICICI Value Discovery and Quantum Long Term Equity are making a mistake by benchmarking themselves to Nifty 500 and I think Sensex or BSE 200 in the case of Quantum Long Term Equity. And ICICI is smart enough to change their benchmark from Nifty 500. They changed it to Nifty 500 Value 50 Index. This is an extremely volatile index. I had talked about this in a previous video. I had mentioned that nobody points out that value investing is actually a risky business. It is much more riskier than investing in the market, let's say Nifty or Sensex. But people get, they are drunk on Munger said this, Buffett said this and that, and so on. They don't understand the risks, and you can get into value traps very easily. It's the point is that in this context, it is extremely easy for a fund like Value Discovery or Quantum Long Term Equity to beat the Nifty 500 Value Index, which is a factor-based index based on low PE, low PB, high dividend yield, etc. So that's why Value Discovery has made a smart move and changed its benchmark, and they can now say they have bet the benchmark, and that's fair enough. However, from an investor's point of view, they don't care about all these factor indices because they want the return to be higher than a broad market index like Nifty 500 because they are paying more. So we are going to look at the performance with respect to Nifty 500, and this is the rolling return, the 1 year rolling returns. The black line is the Value Discovery Fund, the red line is the Nifty 500. You can see here, this is only the direct plan, so you're going to see performance only from January 2013 onwards. 1 year, so January 2014 onwards. The fund was started somewhere in 2005-ish. Shankaran Narain was the fund manager for about 5 years, and then has not been the fund manager, but this is one of his babies, and as CIO, he will not let this go, because he's a well-known value investor, and this fund should be high up in his priority list. So you can see the outperformance here, but in 2014-15, but then somewhere from late 2016 to early 2020, the 1 year rolling return of the fund was always below the benchmark. So that was almost like a 5-year window, almost 5 years, 4.5 years, let's say, where the fund has underperformed the Nifty 500. I'm not looking at long-term performance, because I want to, if you look at short-term, you understand the trends much better. The fund, the sense of the fund managers, where the fund manager is heading. And anyway, these one year returns are going to add on to form a long-term returns, because long-term returns, 1 year outperformance can make a 5-year return positive. Just like we saw in the Sensex video yesterday, one good year can make a 10-year return better for the fund. So instead of that, we're going to look at 1 year windows, so you can see underperformance better. So you can see the underperformance for 4.5 years, and you can see in the green window from about April 2020 onwards, the fund has started beating the benchmark, not by much, but just a little. So like I said, Invesco is holding 10.57% of Reliance. That makes no sense at all. I don't know what kind of contra strategy is this. Now, so the question now is, okay, you have seen some outperformance. Is this outperformance coming because the value discovery fund is kind of mimicking the Nifty, just to kind of, in this market, it's difficult to beat the market. So you kind of hug the index, as it's called, or closet indexing, or whatever you want to call it. So the top 3 stocks of the fund value discovery is 8.9% of Infosys. Infosys is, I think, the second highest or third in the Nifty, I forget. 8.96% of Sun Pharma and 8.78% of Mahindra & Mahindra. This is the weightage of Sun Pharma in value discovery black and in Nifty red. So the stock is the same. The black line is value discovery weight, Nifty weight. You can see Nifty weight has always been below 2% from early 2017 onwards, whereas it's been significantly higher in value discovery. And if you look at Infosys, they have been more or less the same, but the fund has added more of Infosys in recent times. And Mahindra & Mahindra again is very different. The Nifty has been falling down in the Nifty, whereas it's been added more and more in Mahindra & Mahindra. So clearly, value discovery has not been trying to mimic the Nifty, at least in the top 3 stocks. And also, if you look at the Nifty 500 value 50 index, for that index, the top 2 stocks are Grasim at 6.5% and Hindalco at 5.7%. For value discovery, it is only 3.4% of Grasim and 1.37% of Hindalco as of September 2020. So that's good news in a way, that it's not trying to mimic an index and trying to show some kind of outperformance. And whether it's a completely value portfolio or not is a debatable. It's completely debatable, because what is value investing itself is debatable. What is a value stock, what is a growth stock is in of itself debatable. And anyway, the scheme document clearly says it will combine value and growth investing, just for the latitude to the fund manager. So I don't want to get into that debate, but I just want to see the similarity or lack thereof with the index, and I think there is reasonable lack thereof, and therefore that's good news for investors of value discovery. And they can wait and see if this turns out to be better for them. And in the case of quantum long-term equity, I have said, look, if you don't have patience, get out of the fund. But I have patience. For me, my mantra to success, investing success, is discipline and not changing things too much. And I'm not going to change things too much. It's up to you. And if you want to wait and see for a turnaround, that's up to you. It may happen, may not happen. Value discovery may begin underperforming again. We can't say all that. Bye-bye.